Silver domination. China's hidden squeeze, the 25K margin weapon, en route to $100. While the world watches gold, China is quietly draining the silver market, $25,000. That's the exact margin threshold that could trigger the largest commodity squeeze in modern history. Right now, there are 250 paper claims for every single ounce of physical silver that actually exists, and China knows it. They've been accumulating for years, waiting for the moment when the entire system implodes. The route to $100 isn't a prediction. It's already in motion, and what happens next will reshape global commodity markets forever. But there's something they're not telling you. Welcome to Financial Inspection, where we examine the economic realities that shape markets, industries, and strategic decisions. Now, if you've spent decades watching markets, if you understand that real wealth is built on information others haven't connected yet, then do yourself a favor. Subscribe to this channel, not because we ask everyone, but because at your stage, you know the value of analysis that cuts through the noise. And before we proceed, we're curious, from which corner of the world are you watching this? London? New York? Singapore? Mumbai? Drop your location in the comments. Let's see how far this intelligence reaches. Now, let's understand exactly what China is doing with silver and why $25,000 changes everything. In the global financial system, certain commodities hold power beyond their market price. Silver is one of them, but unlike gold, which captures headlines and central bank attention, silver operates in the shadows. And that is exactly where China wants it. For the past decade, while Western investors debated cryptocurrencies and tech stocks, Chinese entities have been systematically accumulating physical silver, not for speculation, but for strategic dominance. Silver is not just a precious metal, it is an industrial necessity. Every solar panel requires silver. Every electric vehicle contains silver. Every smartphone turns every 5G tower, every advanced weapon system, they all need silver. And once silver is used in these applications, it cannot be recovered. It is gone forever. This is where the story becomes critical. China manufactures over 80% of the world's solar panels. They are the largest consumer of silver on the planet. And they understand something that Western markets have ignored. Control the silver supply, and you control the future of green energy. The numbers tell a disturbing story. Global silver mining produces roughly 830 million ounces per year. Industrial demand alone now exceeds 600 million ounces annually. Investment demand adds another 200 million ounces. The mathematics is simple. There is a structural deficit, yet the price of silver has remained suppressed, trading far below its inflation-adjusted historical peaks. How is this possible? When demand exceeds supply, and industrial consumption is accelerating, the answer lies in a system most people do not understand. The paper silver market, on exchanges like COMEX in New York and LBMA in London, silver trades as paper contracts. These contracts represent promises to deliver physical silver. But here's the critical detail. For every ounce of actual physical silver in exchange vaults, there are over 250 paper claims. This means the market operates on a fractional reserve system. Similar to how banks lend out more money than they actually hold, the exchanges allow traders to sell silver they do not possess, creating synthetic supply that keeps prices artificially low. This system works perfectly until someone demands physical delivery, and that is exactly what China has been doing, quietly, methodically. Without drawing attention, Chinese refineries have expanded their capacity dramatically. Hong Kong silver vaults have grown exponentially. Private Chinese investors, encouraged by state policy, have been buying physical silver bars and coins. Meanwhile, official Chinese reserves remain undisclosed, and they do not report their silver holdings. Unlike gold, where central banks publish their reserves, silver accumulation happens in complete darkness. Western analysts have noticed the pattern. Whenever paper markets experience sharp sell-offs, physical silver disappears from the market. Premiums for physical delivery spike. Delivery times extend from days to weeks. Someone is absorbing every ounce available. The strategic implications are profound. China learned from its rare earth element strategy. They did not just buy rare earths. They controlled the refining, the processing, the supply chain, until the world had no choice but to depend on them. Now they are applying the same playbook to silver, but with one critical difference. Silver's market is smaller, more volatile, and far more vulnerable to a supply shock. The total value of all silver above ground is roughly $1.4 trillion. Sounds large, until you compare it to gold's $12 trillion dollars. Or global stock markets at $100 trillion. Silver is a tiny market, which means it can be cornered. And the evidence suggests that is exactly what is happening. Western governments seem unaware, or perhaps they are aware but paralyzed by the complexity of the situation. Because responding to China's silver accumulation would mean admitting the vulnerability, admitting that the paper market structure is a house of cards, admitting that critical industrial supply chains depend on a metal they do not control, so the accumulation continues, week after week, month after month. While silver prices remain artificially suppressed by paper market manipulation, China is building the foundation for commodity dominance, and the mechanism they are exploiting, the $25,000 margin weapon, is about to become the trigger for the largest commodity repricing event in modern history. But to understand how this weapon works, one must first understand the architecture of the squeeze, and that is where the story becomes even more critical. There is a difference between buying something and weaponizing it. China crossed that line with silver years ago. What appears to casual observers as simple market participation is actually a multi-layered strategic operation, one that combines state power, private capital, and market structure exploitation into a single coordinated assault on Western commodity pricing systems. The architecture of this accumulation is brilliant and terrifying. At the top layer sits the Chinese government, not buying silver directly through obvious channels that would trigger alarms. Instead, they use what intelligence analysts call layered acquisition. State-owned enterprises place orders through subsidiaries. Those subsidiaries contract with refineries. Those refineries purchase from international markets. Each transaction appears independent, but the capital flow originates from a single source, Beijing. Then comes the private sector layer. In 2019, Chinese regulators quietly changed investment rules, making it easier for citizens to purchase physical precious metals. Tax incentives appeared for silver bullion purchases. Import restrictions on silver were selectively relaxed. Suddenly, hundreds of millions of Chinese citizens had both motivation and access. The result was predictable. Chinese private silver demand exploded, not because individuals suddenly developed passion for silver, but because the state engineered the conditions for mass accumulation. This is not capitalism. This is state-directed economic warfare disguised as market activity. The third layer is perhaps most clever: refining capacity. China now controls over 60% of global silver refining. They do not just buy silver, they process it, transform it, control its physical form and distribution. When miners in Peru or Mexico extract silver, much of it flows to Chinese refineries. Once there, it enters a system Beijing controls. The refined silver can be sold back to international markets, or it can disappear into domestic reserves. The decision is strategic, not commercial, but the real genius lies in understanding the paper market, the mechanism that has kept silver prices suppressed, despite mounting physical shortages. On the COMEX exchange in New York, silver trades as futures contracts. Each contract represents 5,000 ounces of silver. Traders can sell these contracts without owning any physical silver. They simply promise to deliver it later, or more commonly, they close the position before delivery is required. This creates what market analysts call synthetic supply, paper silver that exists only as electronic entries. The system works because most traders never demand delivery. They trade for profit, not for metal. But here is where the vulnerability emerges. COMEX has two categories of silver inventory: registered silver, available for delivery against contracts, and eligible silver, stored at the exchange but not available for delivery. As of recent data, registered silver at COMEX totals roughly 50 million ounces. Meanwhile, open interest, the number of active contracts, represents over 900 million ounces. The ratio is staggering: 18 paper claims for every physical ounce available, and this is the conservative estimate. When you include options and other derivatives, the ratio exceeds 250 to 1. Now enter the $25,000 margin weapon. To sell a silver futures contract, traders must post margin, collateral that ensures they can cover potential losses. Currently, the initial margin for one COMEX silver contract is approximately $14,000. This relatively low requirement allows massive short positions. Traders can control millions of ounces with relatively little capital. These short sellers profit when silver prices fall, so they have every incentive to keep prices suppressed. They sell aggressively whenever prices rise, creating artificial selling pressure. But here is the critical threshold. If silver prices spike rapidly, the margin requirement increases automatically. And when volatility spikes, exchanges raise margin requirements to protect system stability. Financial models suggest that if silver moves above certain technical levels, margin requirements could double or triple within days, reaching $25,000 or higher per contract. Suddenly, short sellers face a nightmare scenario. They must either post substantially more collateral or close their positions by buying back contracts. But buying back contracts drives prices higher, which triggers more margin increases, which forces more short covering. This is the classic short squeeze mechanism, and China understands it perfectly. The evidence of coordination is subtle but unmistakable. Analyze the timing of major paper market sell-offs. Cross-reference them with physical demand spikes in Shanghai. The pattern emerges clearly. When COMEX prices drop sharply, physical premiums in China surge within 48 hours. Someone is using paper market weakness to acquire physical metal, systematically, patiently, building the pressure. Hong Kong vault data tells another part of the story. Silver storage capacity in Hong Kong has tripled since 2018. New facilities designed specifically for precious metals storage. Located strategically between Western markets and mainland China, these are not commercial storage facilities. They are strategic reserves, built to house metal that may never return to international markets. The Chinese government has studied every historical commodity squeeze. The Hunt brothers' silver manipulation in 1980, the Sumitomo copper scandal in 1996, the Volkswagen short squeeze in 2008, the nickel market crisis in 2022. They learned from each failure and success, and they designed their silver strategy to avoid the mistakes. No single entity appears dominant, no obvious manipulation that regulators can target, just steady, distributed accumulation, combined with patient exploitation of a flawed market structure. Western financial institutions remain largely oblivious. They see Chinese buying as normal market demand. They continue selling paper contracts, confident in the system's stability. They do not realize they are sitting on a powder keg, with China holding the match, and the fuse is shorter than anyone imagines. Because the breaking points are not theoretical, they are already forming. Cracks in the foundation that cannot be repaired, only managed until the inevitable collapse. Every system has a breaking point, a threshold beyond which stability becomes impossible. The silver market is approaching multiple breaking points simultaneously, and they are converging at exactly the same moment in history. This is not coincidence. This is inevitability. Start with the mines, the places where silver actually comes from. For decades, higher prices were supposed to incentivize new production. Economic theory promised that supply would rise to meet demand, but theory has collided with geological reality. Silver is rarely mined as a primary product. Roughly 70% of silver comes as a byproduct of copper, lead, and zinc mining. This means silver production is not really responsive to silver prices. Miners extract it because they are digging for other metals. When copper mines become depleted, silver production falls regardless of silver's price. And that is exactly what is happening. Major silver producing regions are facing depletion. Mexico's primary silver districts are aging. Peru's mines are going deeper with declining ore grades. China's domestic production has plateaued despite being the world's fourth largest producer. New discoveries are rare. Development timelines stretch over a decade. Environmental regulations make new mining projects increasingly difficult. The mathematical reality is stark. Primary silver mine production peaked in 2016 at roughly 900 million ounces. It has declined every year since, currently sitting around 830 million ounces annually, and projections show continued decline through 2030. No amount of price increase can change geology. The silver is simply not there to mine. Then there's the recycling problem. In traditional uses like jewelry and silverware, silver could be recovered and recycled, but modern industrial applications change everything. When silver is embedded in a solar panel, it cannot be economically recovered. The panel has a 25-year lifespan, during which that silver is locked away, effectively removed from global supply. Electric vehicles present the same problem. Silver in electrical contacts and circuit boards, theoretically recyclable, but economically impractical at current prices, even at $50 or $100 per ounce. The cost of extracting silver from complex electronics exceeds its value, so industrial silver consumption is essentially permanent. It is destruction, not consumption. Now overlay the demand acceleration. Global solar capacity installations are not slowing, they are accelerating exponentially. The International Energy Agency projects solar capacity to triple by 2030. Each gigawatt of solar capacity requires roughly 12,000 ounces of silver. Do the mathematics. We are talking about hundreds of millions of ounces of annual demand from solar alone, before accounting for electric vehicles, before accounting for 5G infrastructure, before accounting for traditional industrial uses. The deficit is not theoretical. It is already here. Industry analysts estimate the current supply deficit at 150 to 200 million ounces annually. That number will grow, not shrink. But deficits alone do not break markets. Markets can remain irrational far longer than participants expect. What breaks markets is the collision of physical reality with financial fiction, and that collision is imminent. Look at COMEX warehouse stocks. Registered silver, the metal actually available for delivery, continues declining. In 2020, registered stocks stood at 150 million ounces. By 2023, they had fallen to 50 million ounces. Current levels hover dangerously close to 40 million ounces. Meanwhile, open interest remains enormous. The gap between paper claims and physical metal widens daily. Exchanges can function with fractional reserves. Until they cannot, the trigger is always the same. Someone demands delivery. In March 2022, the nickel market provided a preview. A Chinese company had sold massive amounts of nickel futures. When Russia invaded Ukraine, nickel prices exploded. The short position faced catastrophic losses. Margin calls exceeded $10 billion. The London Metal Exchange made an unprecedented decision. They canceled trades, suspended the market, changed the rules mid-game. Because allowing the squeeze to continue would have destroyed major financial institutions. Silver faces an identical vulnerability, but with one critical difference: the short positions are more distributed. The physical deficit is larger, and China controls more of the physical supply. When the squeeze begins, exchanges will face an impossible choice: honor delivery demands and watch registered inventory disappear, or change the rules and destroy confidence in the entire system. Either choice leads to the same destination: massive price dislocation. Consider the geopolitical accelerants. Mexico and Peru together produce over 40% of global silver. Both countries face political instability. Mining operations are frequent targets of social unrest. Environmental protests shut down mines for weeks or months. Any major disruption to Mexican or Peruvian production, the physical deficit becomes catastrophic. China understands this vulnerability intimately. They have positioned themselves to exploit any supply shock. Their refineries can process ore from anywhere. Their vaults can store metal indefinitely. Their state-backed entities can outbid any commercial buyer. They have built redundancy into every layer of their strategy. Then there is the monetary dimension. Central banks globally are diversifying away from dollar dependence. Gold has been the traditional alternative, but gold's market is large and well controlled by Western institutions. Silver offers something different: a smaller market, easier to dominate. Still possessing monetary properties? If even a handful of central banks began accumulating silver, the impact would be immediate and devastating to the paper market structure. The reflexive nature of the system is what makes it truly dangerous. Each breaking point accelerates the others. Supply deficit drives prices higher. Higher prices trigger margin increases. Margin increases force short covering. Short covering drives prices higher still, which creates more margin pressure, which forces more delivery demands, which depletes physical inventory, which creates supply panic, which drives prices even higher. This is not a linear process, it is exponential. And once it begins, it cannot be stopped by normal market mechanisms. Only by intervention, rule changes, trading halts, forced settlements in cash rather than metal. But each intervention destroys trust and accelerates the flight to physical. China has studied this cycle meticulously. They know the breaking points, they know the timeline, they know the sequence of events that will unfold, and they have positioned themselves to profit from every stage. While simultaneously securing industrial supply for their manufacturing sector, the Western financial system remains trapped, unable to acknowledge the problem without triggering the crisis, unable to fix the problem without exposing the fraud, unable to prevent what is coming. Because the breaking points are not future possibilities, they are present realities, converging, accelerating, approaching critical mass, and when they collide, the repricing will be violent, swift, and irreversible. Numbers do not lie. They reveal truth that narratives try to hide, and the numbers surrounding silver tell a story that most people refuse to believe, until it is too late. Silver at $100 per ounce is not speculation, it is mathematical inevitability. Given the variables now in motion, start with the most basic metric: the gold to silver ratio. Throughout most of human history, this ratio hovered between 15:1 and 30:1. 15 ounces of silver bought 1 ounce of gold. This reflected their relative scarcity in the Earth's crust, and their dual role as monetary metals. In 1980, during the Hunt brothers squeeze, the ratio compressed to 17.1. Silver reached $50 while gold traded at $850. In 2011, during the last silver surge, the ratio hit 31.1. Silver peaked at $49 while gold reached $1,900. Today, the ratio sits near 90.1. Gold trades around $2,650. Silver languishes at $29. This is not normal. This is distortion. Historically, when the ratio exceeds 81, it is always corrected violently. If the ratio simply returned to its 50-year average of 61, with gold at current levels, silver would trade at $44. If it corrected to the historical norm of 30.1, silver reaches $88. If a genuine monetary crisis drove the ratio to 15:1, silver would exceed $175. But there is a more compelling calculation. Inflation adjustment. Silver's 1980 peak of $50, adjusted for inflation to $2026, equals approximately $185. The 2011 peak of $49. Adjusted for inflation, equals roughly $60 in today's dollars. So even at $100, silver would still be 46% below its inflation-adjusted all-time high. This is not bubble territory. This is recovery toward historical norms. Now layer in the supply deficit mathematics. Current annual deficit, 150 million ounces, growing to potentially 250 million ounces by 2028. Total above-ground silver investment inventory, approximately 2 billion ounces at a 250 million ounce annual deficit. Existing inventory depletes in 8 years, but markets do not wait for zero inventory. They reprice violently when scarcity becomes obvious. Historically, when commodities enter structural deficit, prices rise until demand is destroyed. But silver's industrial demand is inelastic. You cannot build a solar panel with less silver and maintain efficiency. You cannot replace silver in electrical contacts without performance degradation. The technology requires the metal. Price becomes irrelevant to industrial buyers. They will pay whatever is necessary, because the alternative is stopping production. This is where $100 becomes not a ceiling, but a waypoint. Consider the trigger mechanisms. Multiple pathways lead to the same destination. Pathway 1, the margin cascade. Silver breaks above $35. Technical resistance levels shatter. Algorithmic trading systems trigger buy orders. Price accelerates to $40. COMEX raises margin requirements from $14,000 to $22,000. Leveraged short sellers receive margin calls. Those unable to post additional collateral are forced to cover. Covering means buying. Buying drives prices to $48. Margin requirements jump to $30,000. More forced liquidations. Price explodes above $60. At this point, the system enters chaos. Registered inventory begins draining as delivery demands surge. Exchanges face the nickel market dilemma. Intervention or collapse. Either choice sends prices toward 3 digits. Pathway 2, the geopolitical shock, major mining disruption in Mexico or Peru, political crisis, natural disaster, or social unrest. Suddenly, 40% of global supply is offline. Physical premiums explode overnight. Buyers panic, industrial consumers scramble for supply. China, holding massive reserves, becomes the swing supplier. But they are not selling. Spot prices decouple from futures prices. Physical silver trades at $60 while paper contracts languish at $35. Arbitrage becomes impossible due to delivery constraints. The paper market loses credibility. Money floods into physical. Price discovery moves to physical markets, where China controls the inventory. And $100 becomes the floor, not the ceiling. Pathway 3, the monetary crisis. Central bank accumulation begins. Even small official purchases create massive impact. If just 10 central banks allocated 1% of reserves to silver, we are talking about tens of billions of dollars. Hitting a market with total value under $1.5 trillion, the price impact would be immediate and catastrophic to short positions. Sovereign buyers do not care about price. They care about strategic positioning. They will pay $50, $75, $100, whatever is required to secure physical metal, because they understand what is coming. Timeline probability analysis. Near-term trigger, 6 to 18 months. 35% probability, requires specific catalyst. Margin cascade or geopolitical shock. Medium-term evolution, 36 months. 50% probability, structural deficit becomes undeniable. Physical shortage forces repricing. Long-term inevitability, 36 to 60 months. 85% probability. Mathematical certainty catches up. Multiple breaking points converge. The strategic implications extend far beyond silver markets. What China has accomplished reveals systematic vulnerability. Western commodity markets operate on fractional reserve principles. Paper claims vastly exceed physical supply. This works until it does not, and once broken, confidence cannot be restored. For industrial nations dependent on silver, the implications are profound. Solar panel manufacturers face supply constraints, electric vehicle production encounters bottlenecks, electronics sector confronts input cost explosions, green energy transition timelines collapse. Because the metal required to build the future is controlled by a strategic competitor. This is economic warfare without firing a shot. China secures industrial inputs at suppressed prices. While simultaneously positioning for massive financial gain, the West faces a no-win scenario. Acknowledge the manipulation and trigger the crisis, or remain silent and allow the accumulation to continue. For market participants, the asymmetry is extraordinary. Downside risk is limited. Silver below $25 has strong industrial demand support. Upside potential is exponential. Movement from $30 to $100 represents 233% gain. But the timing paradox creates psychological barriers. Early positioning feels like catching a falling knife. Late positioning means chasing momentum. The optimal entry was yesterday. The second best entry is today. Portfolio allocation models suggest even conservative investors should consider 2 to 5% exposure. Aggressive investors might justify 10-15%, not as speculation, but as strategic hedge against systemic commodity repricing. The choice is not between risk and safety. The choice is between acknowledged risk and hidden risk. Physical silver carries transparent price risk, but paper assets carry hidden supply chain risk, hidden inflation risk, hidden geopolitical risk, and hidden dependence on systems China is methodically dismantling. The $100 pathway is not prediction. It is probability-weighted outcome analysis based on supply deficit mathematics, structural market vulnerabilities, geopolitical positioning, and historical precedent. Every serious commodity analyst reaches similar conclusions. Even if timelines and trigger mechanisms differ, the destination remains constant. What separates winning positions from losing positions is not intelligence about the destination, but courage to act before consensus forms, because when consensus recognizes what is obvious, the repricing will already be complete, and the strategic opportunity will have vanished, like silver itself, into vaults that will never release it, at prices the market can no longer afford.